Hi, it's Nero here from Investment Rise, and if you have been looking at the headlines recently and you're concerned about what's happening in the property markets, well, certainly the headlines haven't helped your cause, right? I mean, we've seen news about a new interest rate hike again with more expected, and certainly the media is playing up all this bad news about property prices falling, etc. So in this episode, what I want to do is I want to look at what's happening in our various capital city markets, and then also give you some insight into what's actually driving the direction of property prices in different markets. Because of course, some markets are certainly struggling and some are falling, but others are actually holding their value and even growing. And what's the difference between those two markets? I think if you can really come away from this episode understanding the difference, that will really help you as a property investor decide, okay, how to navigate this part of the property investing cycle. And I talk about it as a cycle because if you're looking to build a property portfolio, you need to be able to handle times when interest rates are rising and when interest rates are falling. Okay, so we've got a lot to cover, but first, let's begin by looking at what's been happening to our various capital city markets. Okay, so here we have CoreLogic RP Data Daily Home Value Index monthly values, okay, as at the 31st of July, all right? And again, if you've been following me for any length of time, you know I only focus on houses primarily because, you know, we know over the last few years, house price growth has far outperformed apartment price growth. Okay, there have only been a couple of exceptions to that rule, and generally as investors, you're going to do better focusing on houses, even if it means changing areas to find a house that is at an affordable budget. Okay, so let's look at the house market here and say, let's look at Sydney to begin with. Okay, so last month prices dropped 2.4%, which now is our biggest monthly price drop in forever. Okay, it is certainly quite a substantial price drop. But what's interesting is that if you look at then where prices are from 12 months ago, they're still slightly higher. We haven't seen a massive drop yet based on where prices were 12 months ago. Okay, I'll talk a bit more about what I think is going to happen going forward. And yes, I do expect that as we go later on into the year, and you look at, say, rather than 12 months from end of July, if we look at, say, the 12 months from end of September or end of October, you are going to see negative price growth for that previous 12-month period, okay? So Sydney is definitely the market that is in general struggling the most, and I do expect that's going to continue for some time yet, okay? Melbourne, it's not far behind. Last month prices dropped 1.6%, and for the year, so from this time last year, prices are on average up 0.2%, so they're essentially unchanged. So anyone who's bought property from sort of end of July 2021 until now, the net result is they have probably seen zero price growth, and again, depending on which suburb they're in, they may even have a property now that's worth slightly less than what they paid for it, okay? Then we look at Brisbane, including the Gold Coast. It's had a slight price drop of 1.2%, but look at how much prices have risen in the last 12 months. It's 23.1%, okay, capital growth. So when you compare that to annual growth for Melbourne of 0.2% and annual growth of Sydney of 2.1%, you can see that if you'd bought in Brisbane anytime in the last 12 months, you'd be far ahead of anyone who's bought in Sydney. We're just looking here at median price growth, okay? Adelaide is still continuing to show some strong growth. 12 months to date, 25.4%. It's now the market leader. And last month, it grew 0.3%. Okay. Then look at Perth. It's a market that a lot of people have said, oh, this is a great market. It's going to grow in value. It's still, even if you look at the last 12 months, it's only grown by 5.8%. Okay. Which, mind you, is good for Perth when you compare annual growth over the last 10 years. It's probably one of the best years in the last decade. But on a nationwide basis, you would have done a lot better looking at other areas, okay? And even in the last month, prices have only risen 0.3%, okay? So the Perth market, I still think, will grow, but you're not going to see that explosive growth that we've seen in other areas around the country, I don't think, unless there are some changes in the economic fundamentals. Okay, so then we look at, where are we now? Darwin, price growth in the last month, 0.2%. In the last 12 months, only 3.6%. Okay, Canberra dropped last month by 1.4%. from 12 months ago, prices are still up 10.9%. Hobart has dropped again by 1.2%. And from a year-on-year perspective, so comparing prices to where they were this time last year, Hobart prices are up 10.4%. So as you can see, it's a bit of a mixed bag, but generally speaking, it certainly looks like our capital cities are struggling, okay? So the question though is, what's actually behind this, all right? Now, your first indication, first thought is going to be interest rate rises, okay? And yes, that is the truth, but only partly right, okay? Because here's the thing, property prices are still massively higher than they were at the start of the pandemic, okay? And I expect that they're not going to fall anywhere near that amount, all right? And sure, the prices are falling, but what's driving the prices to fall? It's not sellers who are unable to afford their mortgages dumping their properties, okay? Now, there's a big reason for that, because if you think about it, the cash rate started at 0.1%. That was the record lows. And yes, with all the increases, we're up to now 1.85%. Okay, so that's an increase of 1.75%. All right, now these figures are important because when you look at how loans have been done, how they've been approved, all right, all banks had to, at one point, add a 2.5% loading onto your interest rate when you bought an investment property, or even when you bought your own home. Okay, so what that meant is that whatever rate you were going for at that point in time, they had to say, okay, if rates rose 2.5%, could you still afford it? Only then would you get the loan approved. Then it got moved up to 3%. So then what happened is whatever the interest rate was at the time that you went for it, okay, they would need to say, okay, if interest rates rose 3%, which means if the cash rate rose 3% and banks then copied and increased their interest rate by 3%, okay, then could you still afford it? Only then did you get your loan approved, okay? So why is that relevant? Because if you look at how much rates have increased, they've increased 1.75%, okay? And we're sitting now at a 1.85% cash rate, okay? Most people are expecting the cash rate to hit 2.5%, maybe 3% at a maximum, okay? And I think that 3% is very, very important, because if the cash rate hits 3% after being at 0.1%, that's an increase of 2.9%, which is scarily close, but still under the 3% buffer that people had to show they could afford when they went for a home loan. All right, so this is something I'm not seeing too many people talk about, is the fact that when you're borrowing, back when rates were so low, the banks rather didn't just give you money saying, oh, you can afford it at 0.1%, fantastic, or the cash rate of 0.1%, whatever their rate was. They added that buffer in place, okay? And now with the RBA increasing rates, it seems very, very likely that they're going to tap out somewhere below that buffer, all right? And so what does that mean? That means that if the banks have done their job correctly, if APRA is doing their job and monitoring the banks, all right, then assuming that people's incomes are still as strong as they were at that point in time when they got their loans, all right, they should not need to fire sell their properties, okay? Yes, you are going to see a few exceptions, absolutely, and these are the guys the media will probably troll out and say, oh, look, how bad it is for people, okay? Look, I'm not saying it's going to be easy for mortgage holders. They're going to complain, because I don't want my interest rates are rising on my investment properties, right? No one does, okay? But it's going to be manageable for most people. So therefore, if sellers are not being forced to dump their property, what's driving property prices lower? Okay, it's actually the fact that when interest rates rise, people's borrowing capacity decreases. So that means buyers can't afford as much. And so what we're seeing therefore is a lot of sellers now, because of what they're seeing in the media, they're a little scared. So many sellers are actually now taking their properties off the market and not selling in many areas, okay? I know many people who are trying to find their own home, and they're in a position where they could maybe afford something, but they can't find the kind of property that they're looking for because there just isn't enough stock in some of these markets, Okay, so sellers are being scared off, number one. All right, so you're having slightly fewer transactions. I expect you're going to see more because spring's coming and there's always a more property normally, at least in spring. But the fact is, it's buyers being unable to afford current prices, and especially in our more expensive markets, all right, that's bringing property prices down. But what does this then mean for you as an investor? Well, what are many of these people doing? Well, they're doing two things. Number one, they're either going to keep renting, and that's really driving rents through the roof nationwide, essentially. Okay, some exceptions, but generally speaking, nationwide rents are rising. But the other thing they're doing is they're going, well, look, when prices were at record highs, they couldn't afford it. Now, when prices are dropping, their borrowing capacity is dropping by more. So as frustrating as it is, they still can't afford it. Okay? And so what are many people doing? They're going, look, let's just move. Let's just move to an area that we can afford. Right? And that is one of the big drivers behind many of the more affordable markets. And when I call more affordable markets, I'm sort of looking at markets sub $900,000, okay? Or even sub $600,000 in some cases. I mean, we are finding markets even under $500,000 with great growth potential for our clients. But a lot of these markets are far more affordable for people, even with the interest rate rises. Okay, and add the fact that if you can find those markets with good job creating infrastructure, so there's good scope for jobs and more people being able to have remote working arrangements, okay, you're going to really see the more affordable markets rise in value and definitely hold their value and far outperform the more expensive markets. And this is good news for you as an investor, because when you understand that these median price drops that I shared with you are primarily being driven by the more expensive markets, which are dropping like 4 times more than the average, okay? What that's showing you is that means then the more affordable markets are actually holding their value and many are actually rising. And so as an investor, then you can actually go and target these more affordable markets, especially if you're someone who's low risk, who's worried about cash flow and wants to make sure that you can buy property that's going to give you good, strong cash flow and also get capital growth. All right. And so as an investor, and especially now, it's never been easier to be borderless, which means you can maybe live in Sydney and buy in a regional area, even interstate. And look, I started doing this. That's how I started my investing journey back 20 years ago. Even though I lived in Sydney, I bought my first property in a regional market, completely interstate, and did very, very well. And so I can see many people doing well again. And that's why I think as an investor, if you can cut through the noise, if you can do your research or get the right help, you can find markets that are low risk, that are affordable, where the rents are really strong and might even give you positive cash flow from day one, okay? And then when you get that kind of market and you find those kind of properties, you are then putting yourself in the best position to continue to build your property portfolio or start building your property portfolio. And so that's what I really want to share with you, is that understand why prices are falling, what's behind it. And I think that's really going to help you with your decision making. Don't believe what you're necessarily hearing in some of the headlines about, people are going to dump their properties or they are dumping their properties. That isn't the case, okay? Mortgage foreclosures have not increased, okay? And yes, there might be a slight bump up in some areas. And look, they're probably the areas you might want to even avoid if people are overextending them, all right? But generally speaking, the price drops are being driven by the more expensive areas because people can't afford them. I mean, buyers can't afford those prices because of their borrowing capacity constraints, and therefore they're moving to more affordable areas. Those are the areas that are then going to continue to rise in value. And I believe those are the markets that you as an investor, especially someone who's low risk, wants to be focusing on right now. Hi, it's Nero here again, and thanks so much for watching. If you like what you saw and you're looking for a proven recipe, a blueprint on how to build a property portfolio that gives you passive income, then click the link below this video and get a copy of my book, Wake Up Wealthier, How to Build a Property Portfolio that pays you an income each and every month. Okay, when you click the link and you download your book, you can get both the digital version and the audio version in case you don't like reading. All right, so I used to sell this book for $49, but right now I'm making it totally free. Why? Because I want more people to get this information, and I know that a segment of you will then like what you see in the book and choose to reach out to find out more about our services. But even if you don't, If you're serious about building a property portfolio that pays your passive income, then you really want to get my book, Wake Up Wealthier. It contains the secrets that I have fine-tuned over the last 19 years. It's totally free for a limited time. Click the link below.